4 hours. On March 9th, 2026, Iran issues a public 4-hour warning to the world. The message from Tehran's unified military command is brutally simple. Broadcast is thick, toxic smoke already hangs over their capital. If you can tolerate oil at more than $200 per barrel, continue this game. On the markets, oil futures don't just climb, they teleport upwards. This isn't a threat. It's a declaration of economic warfare, with a specific price tag attached. The question on every terminal, in every trading house, is no longer what happens next, but how did we get here? To understand the cold arithmetic of this collapse, we must go back 9 days, to the single event that lit the fuse. But this wasn't the start of the story. To understand the 4-hour warning, you have to go back 9 days, to the moment the sky over Tehran turned black. March 8th, 2026. The sky over Tehran rips open. A decapitation strike, not a warning shot. A joint US-Israeli operation hits the heart of Iran's energy system, the Shahran oil depot and fuel storage facilities across the capital, the core infrastructure feeding the economy. This is the casus belli, the attack on Iran's energy heart that will later surface as that 4-hour ultimatum. The payload goes far beyond military targets. The arithmetic of the attack is devastatingly simple. Rupture the tanks, then let combustion and chemistry do the rest. The air itself becomes a weapon, a toxic mix of benzene, hydrogen sulfide, sulfur dioxide, and heavy metal particulates. It starts to rain, acidic drops on concrete, while fuel runoff from shattered depots pours into the sewers, turning street drains into columns of fire. This is when the panic becomes personal. You're stuck in Tehran traffic when the music on the radio cuts out mid-song. A harsh tone shrieks through the speakers, and a Farsi voice from the Iranian Red Crescent overrides every station as phones vibrate with the same alert. The message is not a suggestion, it's an order. The food in your home that isn't sealed, throw it away. Your water filter, replace it now. Do not breathe the outside air unprotected. In a minute, the air beyond the windshield is officially hostile. That alert blaring from dashboards and screens across the capital is the moment a precision strike turns into an existential threat for civilians. Inside Tehran's command centers, it shows up as satellite images of burning depots, pollution readings in the red, key fuel nodes knocked offline. Iran's leadership understands the arithmetic. They've been hit at the core of their energy system in a way they cannot answer symmetrically. In an asymmetric fight, the one lever they still control that the outside world cannot ignore is oil flows and price. In that moment, the calculus of the conflict is rewritten. The 4-hour warning, the threat to drive crude toward $200 a barrel, is not the opening move of an aggressor. It is the desperate, retaliatory response of a state watching its own sky turn to poison. The structural reality is that Iran is backed into a corner, outgunned in conventional military terms, dependent on energy exports to survive, and facing a population absorbing the fallout of its own refineries. By reaching for its energy lever, Tehran isn't just signaling defiance, it is putting the global system at risk. Choking flows through the Gulf, and forcing oil toward $200 per barrel levels translates into systemic fragility, energy costs high enough to crush consumers, blow out fragile credit, and snap supply chains built on cheap fuel. Iran's response threatened to collapse the global economy, but it came after a devastating attack on its people. Was this justified self-defense or unacceptable economic blackmail? Share your framework in the comments. With Iran's ultimatum now on the table, a direct consequence of this attack on its energy heart, all eyes turned to Washington for the counter-move. Under pressure from markets, allies, and domestic politics, the United States reaches for a technologically confident answer, one that assumes it can manage escalation and contain prices at the same time. That assumption is about to become Washington's own desperate gamble. That desperate gamble came just hours later, before the opening bell on Wall Street. In an emergency Oval Office address, President Trump stood behind the resolute desk, projecting resolve. He vowed to force the Strait of Hormuz open, sending the US Navy to escort commercial shipping. His tone was steady, the performance polished. While just off-camera, aides watched screens of falling futures, and the security staff knew the fleet couldn't simply erase Iran's leverage in that narrow strait. To investors, the script felt familiar. This wasn't a commander-in-chief outlining war doctrine. It sounded like a CEO managing earnings, trying to talk the market up. He slipped into that cadence. We have a little high oil prices for a little while, but as soon as this ends, those prices are going to drop. If you had money in energy or shipping, the thought was immediate. This is guidance, not strategy. What aren't they telling us about the real risk to flows? This was never a military plan. It was a psychological move, aimed at screens, not ships. Analysts in the New York Times and Reuters stressed that promising escorts and insurance was about calming markets, and that it only worked as long as Iran didn't escalate to the full blockade it was capable of attempting. In newsrooms and on London trading floors, it was treated as that, an emergency bid to steady prices, dependent on Tehran's restraint. For desks watching crude futures and shipping stocks, it read as a bluff, because any rapid attempt to force the strait open risked turning a price spike into an energy shock. In other words, there was no quick military option that didn't carry the chance of something far worse. And that was the deeper problem. Instead of projecting dominance, the address exposed a constraint. The state that had underwritten Gulf Sea Lane security was signaling that its margin for error at this choke point was thin. The arithmetic was obvious in Beijing, Moscow and Riyadh, each recalculating energy pricing power, security guarantees, and how much strain a dollar-centered system could take if this crisis pushed oil toward $200 territory. Those were the calculations that would outlast the morning's price action. The first tangible result of those urgent phone calls wasn't a press release. It was the contrails of several private jets streaking out of the Gulf toward Moscow. On board were panicked ambassadors, diverted not to Washington, but to the Kremlin, sent to ask for the one thing their traditional American ally could no longer credibly offer: protection. They landed expecting a closed door, a side entrance, a discreet conversation in a quiet office. Instead, they were walked straight into the Kremlin press hall. A low stage, a single lectern, and a solid wall of cameras already pointed in their direction, red tally lights burning. Microphones bristled along the front row like bayonets. There was no back channel, only broadcast. The delegation was seated off to the side, half a step below the podium, boxed in by camera tripods and cables. Jackets still creased from the flight. They realized there would be no private assurances whispered after the briefing. This would be decided on live television. The Russian foreign minister stepped to the podium first. His tone was measured, almost bored, as if the outcome had been settled long before the planes left the Gulf. He made it plain that Russia viewed the strikes on Tehran as a violation of international law, that Moscow would deepen its coordination with Iran, and that it would not, under any circumstances, shield those who ignite an illegal conflict and then seek cover from its consequences. When he finished, he didn't turn toward the delegation. He turned towards the cameras.
Lenses swung to the ambassadors, catching the half-second of frozen hesitation, the downward glance, the tight grip on a folder, and then the quiet decision to say nothing at all. That silence, more than any headline, told the region exactly how alone they now were, and the clip would be replayed across the Gulf before their planes even refueled. Oman, which had spent years trying to sit in the narrow space between Gulf capitals and Tehran, broke that posture next. Its foreign ministry issued a public statement condemning the US-Israeli strikes as immoral and illegal. Whatever illusion remained of a shared regional front dissolved in that choice of words, and when Moscow followed by publicly guaranteeing it would veto any resolution at the UN Security Council authorizing measures against Iran, the institutional backstop disappeared as well. As a permanent member, Russia didn't have to persuade anyone. It only had to say no once, and the diplomatic off-ramp vanished. Consider the structural reality. Every capital that turned away from Washington, every statement that cut against American talking points was a direct echo of the explosions that had lit up the Tehran sky 9 nights earlier. The political fallout was just a delayed shockwave from that initial strike. For Moscow, the strategic calculus was brutally simple. Russia didn't need to win in Ukraine to win strategically. It needed to wait for America to overextend somewhere else. That somewhere else was now in the Middle East, a theater where US credibility had been spent in a single night. Alliances were splintering on camera, and energy-dependent partners were suddenly recalculating their risk. America had just provided that somewhere else. Yet this diplomatic collapse, as total as it looked on screen, isn't the real endgame. It is only the political preface to a much colder, more unforgiving reality. Because when the ambassadors and foreign ministers go home, when the cameras stop recording, the only thing left is the arithmetic. And that arithmetic begins with a simple, physical constraint. Storage. With the Strait of Hormuz paralyzed, tankers cannot exit the Persian Gulf. The entire circulatory system of global energy backs up. And the first structural limit is hit. You can keep pumping crude only as long as you have somewhere to put it. Consider Iraq. With minimal onshore storage, it has less than a week before it is forced to shut in over 2 million barrels per day of production. At that rate, every 24 hours eats through another 2 million barrels of remaining capacity. By about day 4, there is simply nowhere left to put the crude. The countdown is mechanical, not political. Kuwait's larger facilities buy slightly more time, roughly 14 days, before its own wells must be choked back. As those clocks run down, the UAE and parts of Saudi Arabia are also forced to reduce output, not by choice, but because the barrels have nowhere to go. Consider the structural reality. When you total that forced shut-in, the market is staring at the removal of nearly 5 million barrels per day. The Strait of Hormuz normally carries about 20% of global oil trade. With it closed, those barrels are stranded. The arithmetic shows what that means in system terms. Global supply runs on the order of 100 million barrels per day, so a 5 million barrel loss is a 5% hit to total supply almost overnight. In past disruptions, traders have repriced crude sharply on smaller losses than that, because in the short term oil demand is not optional. It is embedded in every supply chain. 5 million barrels a day isn't an abstract figure. It is the marginal fuel that keeps the machine running. And when it disappears, prices do not drift higher. They gap higher as buyers bid against each other for the remaining barrels. That is how $200 oil stops being a slogan and starts to look like a clearing price. The market must rise until enough demand is destroyed to balance a 5% physical shortfall. Most of that demand destruction hits transport and food first. It is the diesel for every truck delivering food to your grocery store. It is the jet fuel for a global aviation industry that, at those costs, cannot profitably keep most of its planes in the air. It is the core ingredient for the fertilizers required to grow the food you expect to eat next year. And it is the feedstock for petrochemicals, plastics, and the energy that runs factories and container ships. As fuel and input costs spike, manufacturing margins evaporate, shipping costs surge, and just-in-time supply chains break. As Qatar's energy minister warned, a crisis at this scale has the potential to drag down the entire global economy. The arithmetic now makes that warning concrete. Aviation, logistics, agriculture, and manufacturing are all hit with the same sudden, unhedgeable cost shock. The result is not a temporary slowdown that policymakers can paper over. This is not economic disruption. This is economic collapse by a different name. And Iran is holding the trigger. Faced with that mathematical trajectory, and with diplomatic and economic levers exhausted, the conversation inside the White House narrows to the unthinkable. A last-ditch military option. A high-risk special forces operation designed to physically break the deadlock by reopening the strait. It is a plan born of calculation, under immense pressure, not bravado. And it is a plan Washington has tried before against this same enemy in that same desert. A national humiliation that a previous generation of American soldiers paid for in blood now moves from the history books back onto the Situation Room table. Inside the White House Situation Room, the air is thin. Along one wall, screens show the Persian Gulf in neon. Tanker routes through the Strait of Hormuz, pipeline flows, price charts spiking red. On another, secure chat windows from embassies and carrier groups sit frozen, no new messages arriving. At the center of the table, the chairman of the Joint Chiefs leans forward. So, what are our options? A long pause hangs in the room, heavier than any weapon. Then, from the far end of the table, a voice, low and strained. There is the Delta Force option. The proposal is simple on paper and insane in practice. Send America's most elite operators deep into Iran. Execute a surgical strike to break the deadlock. It sounds decisive, like something from a movie, and that is precisely the problem. As one strategist would later put it, the Delta Force option isn't a military plan. It's what happens when the actual military options have run out and the people in the room are grasping for something that sounds decisive. Consider the structural reality behind the rhetoric. A CSIS analysis makes the fantasy explicit. US naval assets in the region are insufficient to support such a high-risk ground operation against a prepared enemy, and Iran's modern air defenses, a layered mix of Russian and indigenous systems, drive the probability of success towards zero. This isn't an option on a decision tree. It's a symptom of total strategic bankruptcy. Stop. Before we follow the ghost, this plan summons, you need to see the real mistake. The immediate error isn't the raid on the whiteboard. It's the thinking that makes such a raid feel like an answer. The recurring American reflex to reach for elite special operations as a political shortcut, to assume technology and heroism can override logistics, geography, and an enemy with a vote, to confuse cinematic, decisive action with actual strategy. If you don't learn to recognize that pattern, you'll miss it the next time it appears. This isn't the first time Washington has tried to solve Iran with Delta Force and wishful thinking. In 1980, after American hostages were taken in Tehran, President Carter authorized Operation Eagle Claw. a complex Delta Force rescue built around helicopters flying 600 miles under the radar to a secret desert staging area called Desert One. On paper, the choreography looked precise. In reality, the desert imposed its own physics. Massive sandstorms, haboobs, disabled multiple helicopters, leaving too few to continue, and the mission was aborted. In the chaotic night withdrawal, a helicopter collided with a C-130 transport, erupting into a fireball that killed 8 US servicemen. The force fled, abandoning helicopters and classified documents, and the United States absorbed a very public humiliation. Eagle Claw wasn't just a bad night, it was that same defective logic. Complex, high-tech choreography gambled against terrain and an opponent Washington barely respected. Now, look back at the modern Situation Room. See the same confident faces, the same faith that American precision, stealth, and special forces can bend reality to the script. Then match cut to the grainy, flickering footage of burning wreckage at Desert One. This is the same story on a loop. The myth of American military invincibility, of technology always beating terrain and politics, cracked open in that Iranian desert, still haunting the halls of power decades later. And when that myth collides with reality again, the damage doesn't stop with the men on the ground. A failed Delta-style incursion on Iranian soil doesn't just embarrass Washington, it gives Tehran every incentive to retaliate where it hurts the West most. Missiles and drones at Gulf infrastructure, harassment in the Strait of Hormuz, unknown actors hitting tankers until insurers load the risk into every barrel. Oil flows slow, risk premia explode, and benchmark prices spike and stay elevated. From there, the arithmetic is mechanical. Sustained high oil prices bleed into headline inflation. Central banks are forced to choose between tightening into weakness or letting real incomes erode, and risk assets reprice the new stagflation regime. According to an MSCI stagflation model, a failure on this scale, pushing the system into the kind of prolonged oil shock we described earlier as a $200 oil world, translates into a severe recession. In that framework, it's the persistence of elevated energy costs that does the damage. The numbers show a negative 13% hit to US equities and a negative 10% hit to European equities. Trillions in paper wealth erased not by a bolt from the blue, but by a pattern Washington refused to correct. This pattern of failure feels absolute, inescapable, a structural certainty running from Desert One to the present. But that isn't the whole picture. Inside the same data that quantify those equity losses, there is also a quieter signal. A pattern in how capital rotates toward real assets and energy producers long before the headlines admit the crisis. The question is whether you can see that resilience in time, or whether, like most analysts and most algorithms, you only notice it after the system has already reset. This resilience is not a matter of hope. In post-Second World War, US large-cap equities facing geopolitical shocks, it shows up as a repeatable pattern. That pattern is anchored in structure, broad index diversification, large pools of long-horizon institutional capital, and policymakers who move quickly to cap systemic risk when fear overshoots fundamentals. But in the panic window, both human traders and short-horizon algorithms are wired to chase price momentum rather than that underlying tendency to recover. Let's look at the historical record with some discipline. An MSCI review of 7 major US-involved conflicts in the Middle East since 1970 found a clear pattern. In 6 of those 7 cases, equity markets clawed back all of their initial losses within 12 months. On the chart,
Each bar you see is one conflict, its drawdown, and the point at which it got back to even. Put that against the fact that a normal business cycle runs for years. Here, the shock is absorbed inside a single year. The outlier was the 1973 oil embargo, which morphed into sustained stagflation, a fundamentally different kind of macro damage than a short, violent repricing. In most of the other episodes, the same sequence played out. Markets initially overprice worst-case scenarios. Hard information about the true scale of the conflict arrives, and fiscal or monetary policy moves to stabilize expectations. If we pull back and look at all 20 major US military interventions since the Second World War, the same resilience shows up in the flagship US equity index, the S&P 500. Across those events, the S&P's average peak-to-trough decline was about 6%, recognizing that some episodes were deeper and some shallower. The median time to regain prior highs across the full set was 28 days, and in 19 out of the 20 cases, the market was back to even in roughly a month or less. On the scatter plot in front of you, each point is one intervention, mapped by how far the index fell and how quickly it recovered. Most of them cluster in that lower left corner of small drawdowns and fast rebounds. Less than 1 month from peak panic to full recovery is the historical norm, not the exception. For the seasoned investor, this is where signal separates from noise. While others see only catastrophe and dump exposure on the basis of headlines, you anchor on the historical framework. The data gives you a counter-narrative. The volatility around these shocks is rarely terminal. It is a tactical window. That might mean adding to pre-selected, high-quality names or broad indexes at marked-down prices, tightening risk where the fundamentals are genuinely impaired, and above all, refusing to let a news cycle override a disciplined plan. However, resilience is not a return to the old equilibrium. The structural reality is that while index levels recover, they do so on top of a different underlying world. A conflict of this magnitude permanently shifts energy flows, alters global capital allocation, forces new security alignments, and invites fresh regulatory and policy regimes. Navigating what comes next means mapping that new configuration, where the choke points now sit, which actors have gained leverage, which assets now live under a different risk regime. That is the work we turn to next. So let us define that new reality. America's fundamental miscalculation of its military technological superiority triggered a catastrophic strategic failure. The United States tried to subdue Tehran and failed to achieve dominance, pushing the global economy to the brink of collapse defined by $200 oil, with the transport costs and inflation that price forces onto energy importing economies. This conflict proved the old world order is over. The system of unchallenged American power, Gulf security, and stable energy flows has fractured. Markets can no longer treat Gulf export routes or US deterrence as assumptions. Consider the structural reality. It was not Iran's ultimatum, but Washington's escalation behind it that broke the system. The clock striking midnight as risk assumptions reset and the world absorbed the cost of that American decision. At the start of the story, Iran gave the world a 4-hour warning. The 4 hours are up. The old world did not survive them. That warning forced the system to acknowledge a new foundation: structurally higher energy costs, unstable Gulf security, and capital that now orbits repriced geopolitical risk. There is no extension, no return. The consequences of that single strategic misjudgment are now permanent features of our economic landscape. That is the chain. Washington's misread of its military superiority produced the energy shock that fractured Gulf security and the US anchored order, setting how risk is priced and where capital flows. If this framework for understanding transmission mechanisms was valuable to you, and you want to stay ahead of how they hit energy, credit, and real assets, subscribe and activate notifications. We're dedicated to helping you separate the signal from the noise in this new reality.